And that wraps up what has been a very ugly day here for the markets. You're looking at losses across the board. The Dow closing off just around 682 points, so slightly off its lows of the day, but that's good for a 2% decline. The S&P closing off 2.1%. The Nasdaq was a loser today, off 2.7%. That's selling that we saw intensifying into the closing bell. With the Dow off just around 680 points, it looks like it will be the worst day of the year for the Dow. Some of those big tech names that Jared was just going through, Alphabet, Microsoft, Amazon, Apple, we're looking at losses across the board for some of those big tech names, all off more than 2% today. The chip makers are also in the red. Big names like Nvidia today under pressure. Tesla, of course, that's a high growth name that we closely follow here at Yahoo Finance. We have Tesla closing off just around 4.5%. We want to bring back in our panel. We have Ross Mayfield and Teddy Parrish here to help us make sense of some of the action that we're seeing today. And Teddy, I guess from your perspective, from your view, when you're looking at losses like the Dow off 680 points on the heels of that inflation report that we got this morning, does that type of move to the downside make sense to you?
Well, yes. It's good to take a breather. We've had such exceptional performance over the past year or so. And that inflation number this morning, while it might not be, it's a good sign that inflation has come back or has reared its ugly head, but it's not a trend yet. However, the Fed's going to have to pivot. I think the market's worried about that. The day's going to come where inflation is real. I think this is a good sign that it is real. So what that means is at some point, the Fed's going to have to pivot. And when they do, everything that's overvalued, everything that's a bit ahead of itself is going to take a breather. This may be the beginning of that. I can't say that it is, but, this pullback today is just, it's common sense, I think.
Well, Teddy, let's follow up on that, though, this pivot with the Fed, because that's one of the things everyone worries about if they raise the interest rates and the impact that would have on people's easy money access to buy equities. Everybody we've spoken to says this inflation is not only real, it's not going away. That, for instance, we did a whole thing on food prices yesterday, and they're not going to drop because there's a shortage of grains, and we could talk about why that's going on. But the bottom line is inflation's not going to drop. So, Teddy, how quickly does the Fed have to pivot?
I think the language will change first, and then an actual tapering maybe is possible as early as the fourth quarter, early first quarter. If that happens, it could be a similar situation like 2018 when we had a taper tantrum. But they definitely have to take notice because that core number was a very big surprise. It was 3 times the estimate. So if we get a couple quarters where that number is higher than what we expect, I think the language would change first, and then they would actually move the estimate of tapering the securities purchases a little closer.
Ross, we can see investors clearly viewing inflation as a risk to the market. What are some of the best ways, in your view, that investors can use to hedge against this risk?
Yeah, absolutely. Whether you believe the inflation is transitory or you believe that we're entering kind of a new inflationary regime, it's impossible to deny that it's a risk on the horizon for investors. The good news is there's plenty of ways to hedge that, both in equities, real assets, shorting the duration of your fixed income. On the equity side, moving into kind of the cyclical trade that we've looked at, things that take inflationary pressures and pass them on to consumers. There are plenty of ways to hedge inflation. Real estate has been a great one historically. Commodities have been a strong performer in inflationary regimes. So there's plenty of ways to hedge it if you do think it's a risk. And at this point, I think portfolio managers, allocators need to at least be taking it seriously, whether it's transitory or something longer term.
Well, Ross, help us understand this because, for instance, real estate's very expensive right now, and a lot of people, average investors, might be afraid. I don't like the prices I see, but then I'm looking right now, Bitcoin, which keeps trading, it was down today, but the traditional inflation hedge, gold was down today. What gives with that?
Yeah, it's kind of an interesting connecting point between all the things. So, gold benefits from like real negative rates and kind of low yields. Well, if inflation is higher than expected and people think that means the Fed is going to come off the sidelines quicker than expected, could have a negative effect on gold. So all of the relationships are a little bit warped by kind of not just the monetary policy and fiscal policy that we've seen, but the kind of unique nature of the pandemic and the compressed cycle that we're in as well.
Teddy, the losses that we're seeing in a lot of those big tech names, clearly they have been pretty volatile lately. But today we have Alphabet, Microsoft, Amazon, Apple, all off just around 2%. Are you viewing this? Do you view this as a buying opportunity, or do you think we might see a bigger pullback over here in the short term?
And some of those names, I'd say, yeah, there are buying opportunities, and others, no. I think a lot of the tech stocks are overvalued. Some of the chip companies, some of the other software companies are pretty extended. And, analysts have found any way to justify the expensive valuations. There are values in tech, but not very many. I would say that we're buying selectively in tech. We are underweight. I think another 10% down for some of the names that are really extended would be a good buying opportunity. But right now, we're looking at this earnings cycle is true, even with inflation, and a possible move from the Fed. This earnings cycle is strong, and the economy is still going to be good. So I think the reopening stocks and the cyclical plays are the best way to play it. I mean, I would be buying those type stocks. Right.
It would seem, Teddy, just to keep on what you might be buying. I mean, if you're holding on to cash right now, you're getting the double whammy of you're not getting paid anything because interest rates are too low. Inflation threatens that cash you're holding on to. So if you were going to deploy it in equities, you also like, if I'm correct, healthcare and industrials for the very reasons you just said. This economy is going to be reopening, and the expectation is S&P 500 is still going to be higher at the end of the year, right?
Yes, I like healthcare. I like financials. I like energy. I think energy has a lot, pretty good ways to go. I mean, the recovery in oil prices is definitely going to help the firms that were hurt last year. Industrials may take a little longer, but the infrastructure plan that's going to possibly come through is going to be a boom for those companies. And healthcare is just strong. I think a lot of companies have benefited from the pandemic, but also the long-term, aging of the population is still a good catalyst for healthcare. The financials are going to benefit from higher interest rates and also redeploy money in dividends and share repurchases. So they're in a good position. There's a lot of areas you can buy that are actually going to do well as the earnings cycle continues to improve.
Ross, how about you? I mean, how are you viewing some of these reopening plays? Because they have been volatile recently. A lot of those big names under pressure today, airlines specifically, a bunch of them off just over 3%. Is it still too early to bet on these some of these names? You just need to have a pretty tough stomach for it. I guess, how are you looking at this?
That might be the right way to describe it. I mean, circling back to the CPI report, you can see in a lot of these kind of reopening service-based sectors that they're raising prices. They're getting back to work. I think the reopening trade and some of the more cyclical areas in the market, I completely agree. I think that's the place to be right now. And any kind of recovery like this is a once in a kind of generation, event, something that we've never experienced before. So it's not going to be a straight line higher. It hasn't been. The move higher in rates in the first quarter of the year has paused for a bit, but I ultimately think the move in rates continues higher, and that's gonna benefit some of the more economically sensitive sectors. That's where I'd be looking at as well.
All right, everybody take a pause. We got Jared Blickry because Sonos is out with their earnings. Jared, I don't know if you can see it. I got a Sonos speaker right behind me.
I heard it, Adam, and that's what I assumed it was. Let me tell you something. Sonos stock is up 10% after hours, but it was down 9% today. So clawing back some of those losses, good news for those investors. And here's the numbers. They boosted their year forecast. They are now seeing adjusted EBITDA at $225 million, $250 million. Previously, it was 195 to 225. So a real nice bump up by about 30 to 25 to $30 million there. Second quarter results. EPS came in at 12 cents per share, and that is a profit. So that's good news. Last year was a loss per share of 48 cents. Revenue beating estimates coming at 332.9 million. That's up 90% from a year ago, and handily beating the estimate of 248.3 million. And then adjusted EBITDA of 48.5 million versus a loss of 28.4 million. And we'll take a look at a chart here. They did kind of break down recently, and again today. Before the report, you can see we had this kind of neckline here, and we did get below that yesterday. This chart almost looks pretty similar to the NASDAQ, so interesting development there. But you can see over the last year, really benefiting from the COVID trade, they are still up over 231%. So beating on revenue and boosting their full year guidance, really leading investors to an ebullient stage right now after a tough day earlier.
All right, we got some more earnings rolling in. Melody Hom has Bumble for us. Melody?
Stock action as well. We did see shares under pressure all during today's trading session, hitting actually an all-time low for the stock since it went public in February. Now Bumble beating on both the top and bottom lines here very handily. We do see stock action after hours surging about 6%. Revenue did come in much larger than expected at about $170.7 million. We did see EPS. They did turn a profit last quarter at $1.69 per share. Analysts were expecting a 3-cent loss across the board. Bumble has really benefited over the last quarter from this continued vaccine rollout, in addition to people still feeling a little trepidation. So the 1-2 punch there, right, where people are feeling more comfortable FaceTiming for a first date, video chatting rather than seeing people in person. But then there's also those folks who are willing to go to an outdoor bar, dine al fresco, and you are seeing that reflected in the results. We are expecting to get an interview with CEO Whitney Wolfe Herd tomorrow to talk all things earnings. Just throwing it back to you.
Melody, thank you very much. And it's been a long time since we had to fasten the seatbelts to get to the closing bell, but they steered us well. Ross Mayfield, Baird Investment Strategy Analyst, and Teddy Parrish,